So if you were watching the charts at all this week, you probably got a little bit of whiplash.
Oh, definitely.
I mean, Bitcoin dips below $88,000, then snaps right back to over 90.
It felt like the market just couldn't make up its mind. But, it wasn't random.
Right.
It was a textbook volatility flush. We can actually pinpoint the trigger here.
Green deal.
Exactly. President Trump announced that framework with NATO, the planned tariffs came off the table, and the market just, it breathed a sigh of relief.
It's funny, though. While all the day traders were sweating those geopolitical headlines, the big corporate treasuries were playing a completely different game.
That's the real story here. We are seeing this huge split in how companies manage their war chests.
A massive divergence.
But to understand what's happening on the corporate side, we first have to look at the plumbing, because money is moving in some really interesting ways right now.
Like with gold, for example. It hit a record, was it $4,800 an ounce?
Yeah, but the price isn't even the interesting part. It's the vehicle.
Tokenized gold, things like Paxos Gold are up, 177%?
It's a flight to velocity. It's not just about a store of value anymore. Investors want a store of value that can move at the speed of the internet.
You can't really settle a global deal instantly with a physical bar of gold.
Not when it's sitting in a vault in London, no.
And that's the exact same logic driving the news out of Davos with Bermuda, right?
It is. I mean, they announced they're moving their entire economy fully on-chain. That's huge for infrastructure.
They're using USDC for government payments.
Because for an island nation, the old banking rails are just too slow and too expensive. For them, this isn't a gimmick. It's a massive efficiency upgrade. It solves that friction problem overnight.
Okay, so you've got nations and commodities upgrading their rails. Let's look at the corporate equivalent.
The digital asset treasury companies, the DATs.
These are the public firms that are basically proxies for crypto exposure.
Yes, exactly. They're kind of a pre-ETF solution that just never went away. But the mechanics are tricky.
It all comes down to one metric.
MNAV, market net asset value.
So put that in plain English for everyone listening. It's basically asking if you're paying $1.10 for $1 worth of Bitcoin.
Which is a premium.
Or if you're buying $1 worth of Bitcoin for 90 cents. A discount.
Precisely. And that math is causing a real crisis for some of these companies. Since the sell-off last October, most of them have flipped to trading at a discount.
Which explains why the smaller players have just vanished. I mean, firms like CleanCore and Forward Industries haven't bought a Satoshi in months.
They can't. If your stock is trading at a discount to your assets, you can't issue new shares to buy more crypto.
You'd just be diluting your existing shareholders.
The model literally breaks. You're completely stuck.
But here's where it gets really weird. The giants, they don't seem to care about the math.
No, they're buying heavily. Look at Strategy, formerly MicroStrategy.
They've picked up $3.5 billion in Bitcoin.
Just since January 1st of this year.
So what's the play?
It's a massive leverage play. They are betting the company that this discount is temporary.
Right.
They can't issue equity efficiently, so they're probably leveraging the balance sheet itself.
A high-stakes conviction bet.
A bet the smaller players just cannot afford to make.
And then you have Bitmine Immersion Technologies taking a completely different angle.
A really different angle, yeah. They just dropped nearly $275 million on Ethereum.
But they're not just sitting on it.
No, they're hunting for yield. They are staking all that ETH, and they're projecting nearly $150 million a year in rewards.
So it changes the whole narrative. It goes from holding a volatile asset
to generating predictable cash flow. It turns the Treasury into an actual revenue engine.
So this divide is just getting wider and wider. The small firms are paralyzed by the discount.
And the whales are using leverage and yield to accumulate even more.
Right.
It feels like a huge transfer of assets.
From short-term speculators to
long-term infrastructure players, which is why that prediction from Monica Long over at Ripple is so interesting.
She's predicting corporate treasuries will hold over $1 trillion in digital assets by the end of this year.
$1 trillion. And she thinks half the Fortune 500 will have a formal strategy by then.
So if she's right, we aren't just talking about speculative assets anymore.
No, we're talking about the potential operating system for global finance. If half the Fortune 500 is holding it on their balance sheet, crypto stops being a trade.
It just becomes the standard.
Maybe.
We'll be watching that $1 trillion mark very closely. Thanks for listening to this deep dive, and we'll catch you on the next one.